Hello everyone, I'm John Mark Gray, and buckle up, because in this video, we're diving headfirst into the utterly wild and unpredictable price action currently gripping the silver market. Before we unravel that story, a quick but important note. I invite you to explore my books. They're not just good, they are meticulously crafted resources designed to sharpen your financial acumen and provide insights you won't find anywhere else. Consider them an investment in your own market intelligence. But for now, let's pull back the curtain and get straight to our dissection of how futures markets truly operate within the intricate financial ecosystem from a risk management standpoint. As the new year dawns, a tempest brews in the silver market. Prepare for colossal volatility and a brutal culling of traders, as exchanges and brokerages preemptively hike margin requirements, shielding themselves from the very price explosions they anticipate in this tumultuous commodity. This isn't their first rodeo. From a pure risk management standpoint, these institutions are dusting off an old playbook. The last time the silver market ignited with such fervor, they deployed this exact strategy, imposing brutally high initial and maintenance margin requirements that effectively choked the market, leaving many participants gasping for air. Yet, even with their safeguards, these giants weren't immune to the damage. Their sophisticated risk mitigation software, designed to be a digital guardian, often buckled under the sheer force of silver's meteoric ascent. By the time brokers could execute liquidations, the market had bolted, leaving a trail of devastation. Accounts plunged deep into the red, and the horse was already out of the barn for countless traders whose entire capital had evaporated. Collecting from those who had lost everything became a futile exercise, forcing brokerages to absorb substantial write-offs and scramble to overhaul their risk protocols in the wake of these frenzied market events. The inherent challenge lies in the rarity of such cataclysmic events. The last seismic eruption in silver's volatility, a full 14 years ago in 2011, serves as a distant echo. This infrequency makes rigorous preparation a Herculean task. How do you test risk policies and system capabilities against a scenario that plays out once in a decade? When prices whip around with blinding speed, outpacing even the fastest risk software's ability to calculate margin balances in real time and liquidate positions across myriad accounts, chaos ensues. If it were simple, the 2011 debacle would never have happened. Make no mistake, those brokerages believed their existing risk protocols were bulletproof, ready for any storm. Fast forward to today, and the déjà vu is palpable. The silver futures market is once again a cauldron of craziness, already witnessing breathtaking swings. These oscillations aren't just market dynamics, they're magnified by brokerages and exchanges who, in their self-preservation, are yet again hiking margin requirements, often at the most devastating moment for individual traders. It's akin to abruptly changing the rules of the game just as the players are in full stride. A stark truth must be remembered: exchanges and brokerages are self-serving entities. Their paramount concern is their own survival and solvency. Traders and their inevitable losses are, at best, an unfortunate externality. These are businesses, cold and calculating, and when the market truly implodes in a maelstrom of volatility, a trader's best interests are far from their minds. Always anticipate the harshest measures from these institutions. Therefore, steel yourself against vulnerability in these markets, always preparing for the worst-case scenario. If you dare to venture into a crazy market like silver futures, especially amidst a parabolic melt-up, remember that what soars can also plummet. The sheer percentage swings can be utterly ruthless. To survive, drastically reduce your exposure. Trade at least 5 times fewer contracts than you normally would. Fail to heed this warning, and you will almost certainly find your positions brutally liquidated at the absolute worst possible moment, precisely when the market turns. This very dynamic explains why prices in a futures market, or any market, for that matter, often overshoot fundamental logic. It's the cascading effect of overleveraged traders being mercilessly forced to liquidate their positions at the extreme end of significant market moves, fueling the frenzy. Consider yourself forewarned. Exercise extreme caution in a hot, sexy market like silver. The extent of these wild price movements will astound you, and traders consistently, tragically, underestimate the catastrophic tail risk lurking in the shadows. As 2026 unfolds, prioritize risk management above all else. Safeguarding your trading and investment capital is not merely important, it is the absolute bedrock of long-term survival in financial markets. Without capital, opportunity is meaningless. Remember, margin calls and forced liquidations aren't just inconvenient, they're the trader's ultimate nightmare. In volatile arenas like silver futures, these colossal market swings can obliterate an entire trading account in the blink of an eye, banishing you to the sidelines and effectively ending your game.